eked out up 0.75% to officially close at 50,063. The S&P 500 printing a record 7,506, and the NDX touching 26K. The closing bell rang exactly 15 minutes ago on this Thursday, May 14th, 2026.
Right. I mean, it is a massive scoreboard. But the real risk here is buying into that closing print without actually looking at the tape. Because the narrative today isn't a breakout, it's a head fake.
Yeah, and that is exactly why we're doing this deep dive right now. We've pulled the fresh institutional strategy notes, the raw tape analysis, and the internals from today's session. Because honestly, when you look past those glittering headline numbers, the smart money is actually terrified.
Absolutely. The tape is telling a completely different story than the headline indices. We are seeing a severe divergence between what the front page is screaming and how large funds are actually positioning themselves for tomorrow's open.
So let's get right into the data. To understand why Wall Street isn't popping champagne over Dow 50K, we have to look at the volume. Total S&P trading volume hovered near 5.8 billion shares today.
Which is incredibly weak.
Right. It's well below the 30-day average of 6.2 billion. But, I'll play devil's advocate for a second here. If the ultimate result is a record high across all three major indices, does the volume really matter that much? I mean, a win is a win.
It's a win for the scoreboard, sure. But it is a massive red flag for the structure of the market. In a true, healthy breakout session, like the kind that signals a sustained multi-month bull run, you want to see blowout volume.
Oh, Yoon confirmation.
Exactly. You want aggressive, broad-based buying where fresh capital is just flooding into every sector. But that 5.8 billion number, that reveals a severe participation deficit. It tells us this 50K print wasn't driven by an army of new institutional buyers rushing in.
It was driven by a lack of sellers.
Right. The market just passively floated upwards simply because the resistance happened to be incredibly thin.
I mean, it feels like throwing an exclusive, record-breaking party. You've got the banner above the door that says Dow 50K. The music is blasting, but when you look around the dance floor, nobody actually showed up.
Yeah, just a few incredibly wealthy guys in the corner buying all the drinks.
Exactly. And when you look at the internal numbers, that empty party analogy gets even worse. The advanced decline ratio, which is just a basic measure of how many stocks went up versus how many went down, was a mediocre 1.2 to 1. And here's the stat from the strategy notes that I just couldn't wrap my head around.
Deep breath number.
Yeah. Despite the Dow hitting 50,000 and the S&P hitting 7,500, a staggering 59% of stocks actually closed lower on the day.
It's wild. Nearly 6 out of 10 companies lost value.
On the exact same day the market made historic highs, how is the math even possible that the indices hit record highs while the vast majority of the market is losing money?
Well, it comes down to the mechanics of a cap-weighted index.
Yeah.
In the S&P 500, companies aren't treated equally. The larger the company's market capitalization, the more influence it has on the final number.
It's like a tug of war, where one side has 50 exhausted middle schoolers, but the other side has 3 massive professional bodybuilders. The bodybuilders are winning the game entirely on their own, even if everyone else on their team has dropped the rope.
That's a perfect way to visualize it. The foundation underneath the S&P is incredibly brittle right now.
Yeah.
I mean, if we look at the 50-day moving averages, just a basic health metric for individual stocks, only 53% of S&P stocks are currently trading above that line.
Oh, wow. So barely half.
Barely half. And earlier this quarter, that number was 69%. The broad market is quietly bleeding out. But the indices are being physically dragged upward by a shrinking elite class of mega caps.
And institutional managers are aiding this, right, with window dressing.
Absolutely. We're at that point where funds are selling off their losers and buying more of those few massive winners just so their portfolios look good on paper for their clients at the end of the reporting period.
Okay, so if 60% of the market is essentially sitting on the floor, who is doing all the heavy lifting, where did those 5.8 billion shares actually go today?
Well, that leads us directly into what the notes call the K-shaped tape.
Right. We know exactly where the money went. It went straight into Fortress Tech and AI CapEx, the capital expenditure going into artificial intelligence infrastructure.
Those are the life rafts in today's market. Everybody is crowding into them.
Yeah, look at the specific tickers. Cisco gapped up 14% purely on AI infrastructure demand. Cerebras Systems surged 68% on its IPO day to day. And obviously, NVIDIA acted as this massive liquidity magnet, specifically into the close in the final 90 minutes.
Yeah, and that final 90 minutes is critical to dissect. because that late session surge wasn't random, and it definitely wasn't a broad market phenomenon. It was fueled by optimism surrounding the Trump-Xi summit currently taking place in Beijing.
Right. And looking at the facts of that summit completely impartially, putting aside the politics entirely, the market is simply reacting to the tangible possibility of stabilized trade relations.
And more secure semiconductor supply chains, yeah.
Exactly. That specific rhetoric acted as a catalyst for large-scale dark pool buying into the close. And we should probably clarify that term because dark pools sound like some nefarious conspiracy, but it's really just standard institutional mechanics, right?
Totally standard. A dark pool is simply a private exchange. Institutions use them to execute massive block trades without immediately tipping their hand to the broader public exchanges.
Because if a mutual fund needs to buy, say, 2 million shares of Cisco, doing that on the open market would cause the price to spike aggressively against them.
Exactly, so they do it privately. Today, we saw massive accumulation of Cisco and NVIDIA through these private channels into the close, chasing that AI infrastructure tailwind.
But the strategy notes describe this highly concentrated buying as a bearish divergence.
Right, because of that K-shaped tape we mentioned earlier. Imagine the letter K. The economy and the stock market are currently splitting into two completely different directions under the exact same ticker tape.
Okay, so on the upper arm of the K.
On the upper arm, growth and tech stocks are soaring. They are largely backstopped by the Fed pausing interest rates at 3.5%. These tech behemoths are sitting on mountains of cash. They are not sensitive to borrowing costs.
They don't need a bank loan to build a new server farm.
Right. But on the downward arm of the K, you have the traditional economy. The industrial companies, the small caps, and the Russell 2000, they are getting absolutely crushed under the weight of 6.5% mortgage rates and tighter credit.
Because they actually need loans to survive and expand, and capital is just too expensive for them right now.
It is a ruthless macro environment for anyone without a fortress balance sheet.
But wait, even within that upper arm of the K, even within tech, it doesn't seem like a free-for-all. I'm looking at the tape, and there is massive stock-specific bleeding. It's not just a matter of buy everything with a screen.
Oh no, the digestion process right now is incredibly unforgiving.
I mean, take Amazon today. It opened high, right along with the broader tech-led rally, but it completely faded. It bled out to close red at 267.98. It was the clear laggard of the mega caps today.
Yeah, it was heavy all afternoon.
And when you look just slightly outside those giants, at companies like Doximity, they crashed 26.1% today, just never finding a floor. Or New Holdings, down 10% on a revenue miss.
Completely wiping out 3 weeks of gains in a single afternoon.
Right. The notes called it a textbook sell the news event.
And, when you see a sell the news reaction like that, it tells you that the margin for error in this market has dropped to zero. Perfection is already priced into these stocks.
So any slight miss is punished severely.
Brutally punished. When capital hides in fortress tech, it means investors are desperately seeking safety disguised as growth. They're rotating out of anything with even a hint of fundamental weakness. This is classic distribution behavior.
So big money is quietly exiting the broader market, dumping the laggards, and aggressively buying a tiny handful of winners to keep the index afloat. Which means we have this massive concentration of money making the entire structure incredibly top-heavy. And honestly, that brittleness explains why the fear index is behaving so strangely right now. Because normally when the market hits a record high, fear just evaporates.
You'd expect a massive crush in volatility. The VIX should plummet to the floor. The market is happy. Everyone is making money.
But today, the VIX stayed virtually unchanged. It is sitting at a very sticky 17.8.
Which is remarkably high for Dow 50K.
It's like being on a flight that has been incredibly turbulent for hours. The captain gets on the intercom, announces that you've safely landed at a sunny, beautiful resort. The plane is parked at the gate. But every single passenger is refusing to take off their life vests. They're just sitting there strapped in, sweating.
That is an excellent way to conceptualize the options market right now. And there is a very specific mechanical reason for that sticky VIX. Traders are flat out refusing to sell cheap premium.
Break that down for us.
Sure, so in the options world, selling premium essentially means selling insurance to other traders. If you think the market is safe, you sell insurance cheaply. But today, traders are looking at this 50,000 Dow print and saying, I don't trust the foundation of this house, and I am not selling you cheap hurricane insurance.
So what are the options traders seeing that the headline buyers on the public exchanges are missing?
They're looking at the geopolitical tail risk. The fear floor has structurally shifted higher over the last few months. We talked about the optimism from the Beijing summit, but we also have to look impartially at the friction in the Strait of Hormuz.
The energy markets.
Right. That energy corridor is heavily contested right now, and it is directly impacting global commodities. We're looking at Brent crude oil sitting at $105 a barrel.
And $105 oil is not just an abstract number for Wall Street traders. That translates directly to the gas pump. It is a massive tax drag on you, the everyday consumer.
It impacts every single supply chain, every logistics network, and ultimately the profit margin of every retail purchase. When the VIX refuses to drop during a flat, record-high session, the options market is essentially screaming at you.
Screaming that the market is bracing for impact, not breathing a sigh of relief.
Exactly. Institutions are actively buying downside protection, and they're willing to pay a massive premium for it because they know this market has zero shock absorbers left. One bad headline out of the Middle East, or one earnings miss from a giant like NVIDIA or Apple, and the index level drop is going to be incredibly violent.
Okay, so with the market this top-heavy, breadth deteriorating, and fear bubbling just beneath the surface, we need to talk about the immediate danger zone for the active trader heading into tomorrow's open. The strategy notes highlight a very specific technical trap waiting right at the S&P 500's 7,500 level. They refer to it as the gamma wall.
The 7,500 gamma wall, yes.
I see this term everywhere in financial media, but I rarely see it explained practically. Walk us through exactly what a gamma wall is and how it's dictating the tape.
This is where the underlying plumbing of the modern market really takes over the steering wheel.
Right.
7,500 isn't just a nice round number for a headline. It is a massive psychological and institutional pin level.
Okay.
In the options market, there is a towering concentration of open interests, specifically call options, sitting right at that 7,500 strike price.
Let's break down those mechanics. If I am the market maker, the dealer who sold all those 7,500 call options to eager traders, what is my actual risk?
Your risk is that the market goes up. You sold a contract promising to deliver those shares at 7,500. As the actual price of the S&P pushes closer and closer to that 7,500 level, your risk of having to pay out skyrockets. But market makers don't want to gamble on direction. They want to remain what we call delta neutral.
Meaning they don't care if the market goes up or down. They just want to collect the transaction fees. They hedge the risk. So how do they neutralize that massive exposure?
They are forced to buy the underlying futures. As the market rises towards 7,500, algorithms force these dealers to buy S&P futures to cover their exposure. This automatic buying creates a magnetic pull toward the 7,500 level. It literally drags the market up to that exact pin.
But the danger of a magnet is that if the power gets cut, whatever was being held up falls instantly.
Precisely. Because we snapped above 7,500 today on very low volume, that level hasn't been structurally backtested. There is no foundation of organic buyers sitting underneath it.
It's empty space.
Yeah. And that's why the strategy notes identify 7,475 as the absolute must-hold line in the sand for tomorrow's session.
So what exactly happens to our delta-neutral market makers if we cross below that 7,475 level?
The entire machine shifts into reverse. If the market slips below 7,475, the risk for those dealers vanishes. Suddenly, they are holding all these S&P futures they don't need anymore, so they are forced to sell them.
Aggressively.
Extremely aggressively. And because there is no organic buyer support below that level to absorb the sales, it triggers a liquidity vacuum. You get an air pocket where the price just drops, potentially flushing all the way down to 7,400 in a matter of hours.
Man. So the trap is set. The dealers are holding the bag, the market is top-heavy. But what is the catalyst? What is the specific spark that could push us below that 7,475 tripwire tomorrow and trigger that liquidity vacuum?
The strategy notes refer to tomorrow's catalyst as the final boss of the week, and that is the morning retail sales print.
The consumer data.
The health of the consumer. If we connect every single thread we've discussed today, the K-shaped economy, the 6.5% mortgage rate suffocating small businesses, the $105 oil acting as a daily tax drag, tomorrow's retail sales data, will reveal if the American consumer has finally cracked under the pressure.
And if that data comes in weak,
the entire illusion of broad economic strength vanishes. The institutions will realize the consumer can't support the current valuations, and they will start dumping those few mega-cap tech stocks that have been holding the whole index up.
Which means that sideways, low-volume chop we saw today will instantly turn into a severe slide, pushing us right through that 7,475 gamma trap.
Exactly.
And if that slide starts, the institutions already have a day 2 tactical game plan mapped out. The notes outline an asymmetric trade they're calling the semis overextended fade. Essentially, if this blow-off top reverses tomorrow, the high-reward play is looking at short-dated put options on the SPY and QQQ ETFs, or taking a tactical short position on the very semiconductor names that prop the market up today, like NVIDIA.
It is a totally logical pivot. When a narrow market breaks, the capital that crowded into the life rafts is usually the first to panic and rush for the exits. The strategy notes give a trend continuation probability for tomorrow of only 35%.
Only 35%.
Yeah. Historically, when you have an exhaustion day where the indices hit record highs, but the underlying breadth is actually negative, it almost never follows through the next session. Traders are going to look to de-risk. They want to lock in their profits before the weekend, especially with that geopolitical uncertainty in the Middle East hanging over the tape.
It is a phenomenal setup for a potential Friday fade. So, to synthesize everything we've explored in these notes today, Wall Street has achieved these historic, glittering milestones. Dow 50K, S&P 7,500. But when you look past the scoreboard and genuinely examine the tape, it is a house built on a remarkably brittle foundation.
Extremely brittle.
It's being held up by a tiny handful of AI and infrastructure bodybuilders. Meanwhile, the broader market is quietly bleeding out, and the options market is sitting there with its life vest on, paying a massive premium for protection amidst all this geopolitical tension.
And this highlights exactly why critical thinking is absolutely essential in a world of constant information overload.
Yeah.
You simply cannot trade the front page headlines. Just because your phone pushes a notification screaming record high doesn't mean the underlying reality matches the enthusiasm. You have to look at the volume, you have to understand the breadth, you have to look at the volatility structure, you have to constantly ask yourself why the market is moving, not just how much it moved.
You have to look around the dance floor and see who is actually at the party. Which leaves you with one final provocative thought to mull over as you prepare your charts for tomorrow's opening bell. We know the current situation. We know the K-shaped tape, the hidden fear in the options market, the heavy reliance on cap weighting. But think about the basic mechanics of exhaustion. If a staggering 59% of the market is already pulling back, struggling, and dropping the rope while the indices are artificially propped up at record highs, what exactly happens to the entire structure of market when those few remaining giant tech pillars finally need to take a rest?
The floor drops out.
Yeah. Keep your stops tight, respect the tape, and thanks for joining us on this deep dive into the real mechanics behind Dow 50K. We'll see you next time.